Hey, Ty Miller here with Five Plan Partners on the Portfolio Strategies team. Hope you're doing well today. Today's topic for our educational vlog that I would like to discuss is the difference between mutual funds and ETFs. Both are things that we utilize here at Five Plan Partners for different reasons. First, I'll kind of start off with some of the similarities. So both take a pool of assets and invest them across, for diversification. So for instance, there's equity mutual funds or ETFs that will invest in stocks, or they may be sector specific ones such as the materials sector or the tech sector. And they will take a group of stocks that fit those requirements and they will invest across that spectrum. So you could have even an S&P 500 kind of ETF or an S&P 500 mutual fund that will invest in the 500 companies of the S&P for diversification purposes. And so they're very similar in that way. And the same goes for fixed income for bonds. They will do, the same thing there. How can they can both be traded in individual accounts or retirement accounts, either or. Now, how are they different? ETFs are typically a little more tax advantageous because they are passively managed, whereas more mutual funds are actively managed. And by that, I mean the ETFs will have a specific goal in mind or a specific sector perhaps that they lean towards, and they won't have much turnover because the companies in the material sector, they're still producing materials, 5 years from now, 10 years from now, they're the same companies for the most part. There's very little turnover there. They're a little more tax advantageous as opposed to mutual funds where they're a little more actively managed. They're looking for maybe to beat the market or to beat an index. They're looking for results where they can perform a little better. And so because of that, they may have some more turnover, which would make them less tax advantageous for people. So, ETFs, they also price like stocks where you can trade them throughout the day and have a real-time price, whereas mutual funds, they only price at the end of the day. And so, if you sell in the middle of the day, you get the end of the day price. You don't know, it doesn't trade throughout the day like a stock necessarily, where the price is fluctuating. You just kind of get one price at the end of the day there. So, I kind of went over some of the differences there, and you're thinking, well, why don't they just do ETFs? Why doesn't everyone just invest in ETFs? Well, mutual funds, again, they have that active element to them, which is beneficial, if you're looking for a return perspective, possibly. And then, of course, there are some differences that lean towards mutual funds, whereas if you're contributing, monthly or quarterly or whatever it may be, you can buy mutual funds systematically. You can set that up so that just automatically processes. That's a nice feature that ETFs don't have. They don't offer that. And then mutual funds, you can also buy partial shares. So if you have $500 that you're trying to, contribute once a month, that mutual fund, once you set up that transaction, it can buy, partial shares. It can buy 2.5 shares, let's say, whereas the ETF, it has to be a whole share amount, like a stock in that instance, where you're not, not a lot of platforms offer the ability to buy partial shares of stock. The same goes for ETFs where you're having to buy whole share elements. So, if an ETF is trading at, $400 and you only have $200, you have to wait. You have to either wait until you build up that $400, or maybe you could look at a mutual fund that does, similar things, and you can buy half a share or whatever the price may be, and then buy the other half a share when you contribute again. But those are kind of the differences that I wanted to go over today. I appreciate your time. As always, if you have any questions, call us, email us. We are here for you. I will talk to you again soon. Thanks.